Good morning, good afternoon, and good day, everyone. Welcome to today's webinar on the top 5 KPIs for professional services organizations. My name is Vijay Ramakrishnan. I am from Intact, and we are the fastest growing provider of best-in-class cloud ERP software. I'm your host for today's session, and our featured speaker is Dave Hofferberth from Service Performance Insight. Dave will be getting on the line shortly and introducing himself and speaking to you on that very important topic of the KPIs that you need to be monitoring in order to ensure success as a services organization. Before we get to the heart of today's session, I wanted to share a couple of housekeeping details with all of you. We invite your questions during the course of the webinar. So as we're going through the materials today, if questions come up for you, for Dave or for myself at Intact, please feel free to type those questions into the chat box or the Q&A box, and we'll get those addressed for you. In the event we run out of time for questions, we will follow up with you individually afterwards. Also, as a course of follow-up, we're going to be sending to you a copy of this presentation and a recording of the webinar in follow-up emails after the event. Dave's prepared a lot of great information for you, so rest assured that you'll have all of that as reference material after we conclude today's webinar. And as we conclude today's webinar, just a reminder as you exit, if you could do us a favor and fill out the survey at the end, that will help us continue to improve the value of events like these for you. Before I hand the floor over to Dave, I just wanted to do a quick introduction to Intact. As I said, we are a provider of best-in-class cloud ERP software. We've got over 11,000 companies that are relying on Intact as their financial system of record, and many of these companies are services companies, professional services companies. They're taking advantage of our project-centric ERP solution to help their project-based businesses grow. And we've been helping them in two ways, by automating complex processes, really making connections across the entire service delivery lifecycle, from sales to delivery to finance. And so automating complex processes is one way we've been helping our customers grow. But the second way we've been helping our customers grow is really to provide deep insights that help all of those folks involved in bidding on projects, booking them, delivering them, analyzing them, providing them the insights that they need to make day-to-day decisions, as well as those longer-term decisions that can shape the growth and the profitability of your services organization. And that's really the topic of today's webinar. Is, what are the kinds of insights and KPIs that you're going to need and have access to in order to be effective as a services organization. And so with that, what I'd like to do is hand the floor over to our featured speaker today, who is Dave Hofferberth, and Dave's going to introduce himself and carry it the rest of the way. So Dave, the floor is now yours.
Okay, well, thank you, Vijay, and I appreciate everyone coming to the webinar today. My name's Dave Hofferberth, and I've been an analyst covering the professional services market for about 20 years now, with both the Aberdeen Group and then with Service Performance Insight, or SPI Research. And again, I do enough webinars, but every time I do it, a lot of people don't know who SPI is. And I just want to quickly tell you, we're a globally focused research and consulting firm that specializes in business improvement and transformation for project and service-driven organizations. We celebrated our 10th anniversary earlier this year, and we're considered the leading analyst in the professional services market. So over a decade ago, we began development of the professional services maturity model, which now is considered the industry standard, and it's designed to help professional services organizations assess, prioritize, and implement service performance improvement plans. Now, earlier this year, we published the 2016 Professional Services Maturity Benchmark Report, and today's webinar, I used information from 370 independent professional services providers in this study, and they include organizations such as IT and management, consultancies, architecture and engineering firms, accountancies, and others, to name a few. Having a little difficulty moving the slide for some reason.
I can move them for you, Dave.
Okay, I just got it moved. We'll try it again. So today on my agenda, I want to first explain what the professional services maturity model is, just so you get a better understanding. I'm going to talk a little bit about some things that we're seeing in the industry, and we just finished surveying for the 2017 report, so there'll be a couple tidbits of information there that I'll pass along. We'll be publishing that report in February, by the way. Then discuss where to start your performance improvement initiatives, followed by those 5 KPIs that we believe will drive greater financial and organizational success, and then a little bit about integrating your information infrastructure, because at the end of the day, that's going to help you become more efficient and more productive. And then I'll wrap it up and take questions later. So the first thing I wanted to explain to the people that aren't familiar with SPI is what the professional services maturity model is. So I'll explain that. I'll explain to you, how it was built and what each level means, and then I'll show you some scores to help you better compare your organization to it. So again, we built this model a decade ago on 5 fundamental pillars that mirror functional groups within professional services. The first is leadership, the C-suite individuals, and it provides a unique view of the future and the role the service organization will play in shaping it. It highlights where and how professional services executives can offer a clear and compelling strategy and help provide a focus for the organization to galvanize action. The second pillar is client relationships, which really concentrates on the effective of your sales, marketing, and partner relationship organizations. The central pillar is called human capital alignment, and that means your people. And again, in professional services, your people are the most important asset. This pillar is focused on recruiting, hiring, retaining, and motivating a high-quality consulting staff. And then fourth is the service execution pillar, which is really everything to do with delivering project or service-based work. It's from planning through resource management, project management, delivery tools and methodologies, and some of the tools that your organization will use to capture time and expense. And then finally, of course, the finance and operations pillar, which is the management of all financial information, from revenue to margin to billing to collections, and also includes your IT infrastructure. Now, in each one of these pillars, we developed 5 levels of maturity, which progress from level 1, where processes are immature and the employee's roles are yet defined, all the way up to level 5, where the organization, methodologies, tools, and governments are very structured, and the organization moves in a very defined and successful manner. And we built this model so that only about 5% of the organizations make it each year. And so I said earlier today that this data we used came from 370 independent professional services providers at the end of 2015. In all, we surveyed last year about 549 service organizations, but I really wanted to focus today on the areas, the markets where most of the people on this call will be. And as you can see, we have a really strong contingency in IT consulting, but we're building up the advertising, accounting, and architecture engineering firms little by little. And so again, when we start explaining the model to people, we always get questioned, why is this important? And like I said earlier, we use 5 levels to analyze 5 levels per each key performance indicator to measure the impact of improvements on the people, process, capital, and technology of services. It not only measures individual service performance, but actually correlates all areas of your organization. And what you can see from this slide is, as organizations move from level 1 to 2 to 3 to 4 to 5, you can see, for the most part, improvements in some of these more important financial KPIs. Again, I've done this enough times that everybody always immediately stares at the bottom number and bottom row. And what we think that's important is because profit is how your organization will invest in its future. So in other words, how it will grow. And the first two columns, level 1 and level 2, that represents about 55% of all organizations that have taken the survey. So what I'm showing on that slide is 55% of the organizations we surveyed averaged less than 5% in profit. And that's really not good in independent professional services organizations. They should be shooting for at least 20% on an annual basis, again, to help them grow. And so we like to say financial maturity cuts across all departments. And to do that, you know, you've got to accomplish high levels of profit so that they can, the whole organization can move in the same steps. So we start out with accounting and financial. Like I said, it's the organization that monitors and measures everything, every dollar that impacts your organization. But then the executives, they need this information to understand which services are offered, what is the highest probability of moving forward and growing in terms of different geographic regions and so forth. And then, of course, marketing and sales needs this information to better understand the costs associated with selling and delivering services. Real important that we'll get into some of the KPIs later, but for instance, the bid price. I get this asked all the time, you know, what if we win all of our bids? Well, I always tell them, if you've won all your bids, there's a chance you're pricing your services too low and you're hurting yourself from additional profitability. And then, of course, your employees. We need to understand the cost, the types of individuals that we will hire within the organizations, what benefits, what training. But in other words, you can't hire people that don't generate a profit to your organization. And then, of course, service delivery, and that really is just capturing all your time and expense information, invoicing your client, and analyzing your profit margin to see how and what you could do better going forward. And so it's interesting, this slide, I always like to look back a few years to see what were the top priorities of professional services executives. And what we found interesting, you know, was way back in 2010, we were having trouble with sales. Revenue growth was not good, and therefore the executives really started to focus on selling. Well, of course, they did a good job of selling after that, and of course, then the difficulty for them was executing services with high levels of quality, on time, on budget. And then 2012 was when we really were first introduced and tried to introduce people like you, the problems associated with the talent cliff and the fact that organizations were having a difficult time finding talented individuals with the right skill sets. And then, of course, we get into 2013, it turned into profit. Well, it's interesting, those 4 years, they kind of repeat themselves to a degree, to where a year later it was sales, a year later it was about bill rates. And right now it's interesting, there's some focus on talent again. Now, none of these ever go away, but the survey we just completed, and we just don't have it totally quality controlled yet, we found that talent was the #1 issue for 2016. So, you know, stay tuned to what we're doing with that, because this report will be out in February. And so then I wanted to move into some trends that are definitely impacting the marketplace. And again, like I said, we're just putting it together for the survey we just completed doing. So I'll be able to get back with you later. Well, the first issue that we had some problems with, or we were concerned about, was the sales pipeline. The deal pipeline is compared to quarterly bookings forecasts. It's an important leading indicator because it provides insight into the sales effectiveness and future revenue. So as you can imagine, a bigger pipeline enables your organization to not discount as much as they had in the past. And the problem here, as you can see, that last year the pipeline went way down, which meant that was ultimately going to negatively impact profitability, because organizations like yours probably had to discount more than you intended on doing to build that pipeline back up. The second one was, the second market trend that we thought was real interesting was the bid-to-win ratio. So this means this is the number of bids out of every 10 your organization submits. How many do you win? Now you can see it's usually around 5 out of 10. So in other words, for every 10 bids your organization presents to prospects, half of them are getting rejected. We love to see this number around 7 to 8. If we see 10 out of 10, there's a good chance you're selling your services at too low of a price, and therefore, you're hurting yourself from a margin perspective. The third trend we saw that is getting worse, as a matter of fact, this year it'll be even worse, is attrition, both voluntary and involuntary. And it's really just the number of employees who left the company, either voluntary or involuntary, divided by the starting employees at the beginning of the year. And, of course, there's reasons to get rid of your poorest performers, no doubt about it. But what happens is the market improves, your competitors start coming after your best resources, and that's why we think that the attrition rate went up so significantly last year. Was firms really need people. That talent cliff that we talk about, getting all those STEM people, science, technology, engineering, and math, those individuals are in high demand right now, and so we expect turnover to be even higher in 2016. And then, of course, revenue growth. So it's a real interesting thing in professional services in general. We like to see around 10% growth on an annual basis, and for the most part, that's what we've seen. Well, 2015 was the first time it dipped below 10% in probably 7 years, and we think in 2016 that number is going down just a little bit more. So in other words, your organization has to focus its efforts around revenue, and growing your client base. And then finally, profitability. This for independents, this number generally is above 12%, and it is this year. I think it's going to go down a little in 2016. But it's funny. If I talk to a group of government contractors or some of the architecture firms that I speak with, they're happy at 5% profit. Well, most of the organizations we deal with are over 10, and they would be hurt if they did not achieve 10% EBITDA. So, in other words, there's been pressure on this for a while. In 2016, we expect it to go down just a little, but that just means you have to double down your efforts in terms of managing everything with the cost at your organization. And so with that, we have a couple polling questions in today's webinar. I can't see the answers until somebody gives them to me, but I'll ask you, and I hope you participate because this is always interesting for the users. So does your company have plans to improve profitability in 2017? We don't. A is we don't have a specific plan. B is we are very early in the planning stages. And C, we really feel we're ready to execute a plan. And so if we take a minute or so and you all can enter, and then VJ can tell me and pop the results or tell me the results, that would be great.
Sure, Dave. We have people still responding right now, and so the answers are still coming in. So thank you, everyone, for participating, and we'll be giving you, a minute or a second or two to enter your answers here. And so, Dave, I mean, what are your, what do you see in terms of, when to start this process? Is this something that you expect people to be in right now, or we're getting to be towards sort of 2 weeks away from the end of the year?
Yeah, right, VJ. I think what we see is generally companies begin Q4 or October of the year, and if they operate on a calendar year, they start really developing the big plan in October, and that gives them a month or two to make sure that everybody is in agreement with how the organization is going to move going forward. And usually by the end of November, the plans are in place, and then December, there may be specific actions taken to implement those plans so that January 1st, these organizations are off and running, quickly. And so, again, I don't see the answers yet. Have you?
Yeah, just to let you know, Dave. So we had about 13% who chose option A, And then most folks, are in the thick of it. They have early plans. 63% have early plans to improve profitability, and 20% are ready to execute on that plan.
Okay, and that's I think again we're in the middle of December, so I'm hoping that your plans get expedited because you really want to finish everything before the end of probably before the Christmas time when there's holiday seasons and a lot of organizations take off or employees take off, and you just want to have everything in place January 1st so that when people come back to work, if they've taken some time off, they're ready to hit the ground rolling. So again, very interesting that 60% over 60% were very earlier in their plans.
Sure. Hey Dave, we have a question that came in, and so I'd like to pose that to you.
Sure.
Remind the audience that we do love questions, and so if you have any that come up for you during the course of the webinar, type them in. The first question pertains to that revenue growth graph that you showed a couple of slides ago. And the question is why is revenue growth declining as the economy is improving? I don't know if you have any perspectives on that. Maybe it's competitive pressure. So what are your thoughts on that?
Well, there are a couple things there. Well, first of all, the economy, I believe, is growing at 1 to 2%, and I think normally in a good economy it grows at about 4%. That's before the people get involved with raising rates too high. So again, I think that the economy has been growing, but by 1% or 2 each year isn't enough because most companies can improve efficiency 1 to 2% a year with the people they have, and therefore there's no need to hire if that's happening. So it is interesting, and again, revenue growth was good. Professional services organizations are in demand. Again, I always say this is the market where we're the game changers for the rest of the economy. Whether it's a new information technology solution that will help make you more efficient, or a new building or road that will make things better. Again, it's just all these high-paid consultants that really are smart and can do a lot of things to help grow the economy. So, we'll wait and see what really happens in this market going forward. And like I said, we just finished surveying for 2017, so we should have those results out in a few months then.
Great, thanks, Dave. And just a reminder to the audience that this will be the presentation will be available to you. We'll email these slides out after the webinar.
Yeah, that's good too, because I realize I put a lot of numbers in these things, but the goal here is to help everybody get a better, more clear understanding of what's happening. And so when we looked, every year we ask what are the planned steps organizations take to improve profitability, and for the most part, we thought was interesting was that raising rates typically in years gone by was not that important, but I think a couple years ago they started becoming important for everyone in the market. And then last year, they really became one of the top areas. And as a matter of fact, this year, we're seeing kind of things associated with getting better people, improving the solution portfolio, and so forth. So again, every year there's changes brought, and every year your organization has to emphasize another area. And so when we work with companies, we like to use the term "get the red out." And what we do and what you can do right now is take just the information from this slide. And again, we capture about 200 KPIs on an annual basis, but here is maybe 15 or so associated with your financial organization. And you can see what your numbers are compared to some of the others to see whether you're in red, orange, yellow, blue, or green. And of course, we tell everybody, don't worry about the things you do extremely well. Really double down your efforts to improve areas where you're level 1 or level 2, because ultimately that will give you the biggest bang for your buck and will help you not only grow more successfully, but grow profitability more successfully. So again, when people read the report that we write and they go into specific KPIs and compare themselves, to those level 1 through level 5 key performance indicators, they get a better understanding of where they need to improve operational efficiency. And again, there's a lot of things you can focus on within the organization. Again, a lot of companies right now are focusing on talent. But ultimately, your firm really has to focus on revenue, revenue growth, profit, and quality. And so we look at everything from what can you do to positively impact those areas. And, you know, from clients, from your strategy to your clients, to your people, to delivery, there's a lot of things you can do that will ultimately help you improve revenue and profitability as well. So again, it's the executives working with all the other departments within the organization, better understanding what your clients need, better understanding what your employees need, and then figuring out how to deliver services that meet client demands and make it easier for you to sell the next service to them. So again, we like to say when we talk about this model that we've built is that everything impacts professional services. Okay, and so, you know, here's a somewhat simple slide, but it does, you know, shows you how important some areas are. So on the far right, you can see profit. Ultimately, you want to get a lot of profit. You want to achieve high levels of profitability. Well, there's two ways, there's two things you do. You can bill more hours or you can bill at a higher rate. And if you do that, if you're trying to move your organization to become more profitable, you know, there are things to do that will help you more, increase revenue, such as moving to more strategic services as opposed to generic services that maybe you have a lot more competition. We see companies that sell big projects, and that's not easy to do, by the way, but longer duration projects help keep all of the financial KPIs happy, such as billable utilization, revenue per employee, revenue per consultant, and so forth. And then your bill rates. Remember I said when the pipeline went down, you're going to have to discount. And it turns out that's always a problem, because then you may not be able to hire the best people who can charge the highest bill rate. So again, focusing on your talent, focusing on dedicating sales, the organization to sell more services. And we talk to a lot of people about implementing service packages where you turn a service into a product, so to speak, because it makes it easier to sell. Now on the cost side, you know, there's labor and there's overhead, and those are the things you try to minimize to a degree. We tend to see the best operating firms have less than 40% of their revenue dedicated to labor. So in other words, there's all kinds of other things. There's sales and marketing, there's technology spend, there's other G&A type things that, you know, you try to manage as best you can, but it's that labor cost that's so critical in the overall calculation of profitability that it's one area that you want to focus on. So, you know, making sure when you deliver work, you have the right margins built in based on the individuals you have planning to sell it. And so a lot of companies will take that and have one or two senior level and more expensive employees and a number of junior level employees that can sell it, can perform at high margins. So again, you have to balance all of these areas to better make profit going forward. And again, you're monitoring the cash out the door, which is the payment for employees, you know, recruiting, hiring, training, retaining, compensation, and so forth. And then there's project costs such as travel and materials. Sometimes you're compensated for that, sometimes you're not. And then, of course, your SG&A costs. And remember, then, the only way to make money is to bill. And what we find difficult is that, you know, for instance, we see something like days sales outstanding, which is a financial metric that tells you on average how many days it's taken clients to pay. And we like to say under 30 is great, over 30 is bad. We also see a lot of issues associated with rejected invoices. One of the negatives of that, of course, is that you have to regenerate an invoice if it's wrong. That ups your days sales outstanding. And then some of your client payment policies in terms of, you know, what they say they'll pay and how quickly they say they'll pay. And then finally, and I thought I saw something on a question asking about revenue leakage. Revenue leakage is, you know, I probably should have put that up here too, because revenue leakage is when you just didn't bill something. So again, how do you collect all that time and material and costs in one place so that you can send an accurate invoice? Because if you forget if you forget hours that you worked, or you forget something that you, a piece of equipment that you bought, ultimately you probably are not going to be able to bill that, and therefore you're going to, you're losing money right away. So real critical to follow the money and follow the costs associated with delivering services. And again, it's funny, especially in professional services, because it should be an easy process. You work, you invoice, and you collect. And, you have to plan accurately. You have to resource so that your people are not sitting on the bench doing nothing. And then you have to capture all their time and expense. You create a great invoice and you send it to the client, and they pay you for it. Again, it's a lot easier, I think, than some of the other markets to go through, but yet we still see problems here. And first of all, the first one, work is completed late. Well, we find that around 20% of all project-based work in professional services is delivered late. That may or may not be the professional service organization's fault. It may be scope creep that threw everything out the window, but at the end of the day, you've got to figure out how to get the work done, and you've got to get an accurate invoice sent out. Sometimes the wrong work is done. There's a disagreement in terms of the scope of the project and what everyone is supposed to do. And then again, invoices are incomplete, leading to revenue leakage, just like I said, or they're just wrong. So again, it sounds easy. You do work, you invoice for the work, and you collect the fee, and it just doesn't tend to be that easy, and that always hurts profitability going forward. So now we have our second polling question, and one of the more important key performance indicators in terms of delivering services is this. We have a standard set of service-focused profitability KPIs, and I'll be interested to see the answer because we've asked this one a few times. First answer is we track just a few regular KPIs. The second one is sometimes we measure better than other times. The third is we're pretty happy with the metrics we measure, but not the methods of measuring. And choice D is we're happy with both the metrics and methods we use to track those. So give you guys a couple seconds, and then VJ can tell me the results.
Yeah, and we're giving folks are putting in their responses, Dave, as we speak right now, and so we're getting the results come in. I want to go back to something that you said about the process of generating invoices. One of the reasons people come to Intact is because of that revenue leakage problem, and what they're finding is they have two separate sets of data running on the delivery side and the financial side, and so data just gets lost in the process of moving from either the spreadsheet or the system that's being used to track the work and the costs and the hours, and the financial system that's generating the bill. So that's something we help people with quite a bit. Looks like we've got the results coming in, Dave. And
okay.
So choice A, we had 68% of folks select that. Choice B, we had 17%. We had 7% select choice C, and 3% on choice D.
Okay. That's pretty normal. Usually, the answer to this, or the most popular answer, is A or B, and that makes sense. Again, we track around 200 KPIs, in different organizations. Use different ones to run their business. What we try to do is provide companies with as many as we can, and there may be one that you finally turn to help you improve performance. So, real interesting. And piggybacking on what you had said earlier about, what Intact is doing, also what's important, and I think you'll probably talk about it later, is the fact that the integration of some of these other enterprise apps with the back office financial management system, that's critical too, so that everyone who can see what they're doing and how that ultimately impacts cash flow, growth, and profitability. So again, integration is something I talk about all the time. I'll talk about it here in a couple minutes, but it's something very important that everything does go back with the core financial management solution. All right, I'm going to try to change the slide. There we go. Okay, so finally, the 5 KPIs that we believe you should track to better improve your organizational profitability and growth. The first one is billable utilization, and I think most people know what that term means. They may not agree with how to calculate it. Some companies just say, how many hours did you bill a year out of 2,000? Some companies will take how many hours you work, and use that as a denominator, and use how many billable hours you worked as the numerator. We like to make it easier, and we calculate it several ways too, but we try to make it easy for an organization like yours and say, basically, there's 2,000 working hours in a year. How many hours a year do you bill? And what we found was that organizations that billed about 1,500 out of that 2,000 and up, they showed greater, really significant changes in some of the KPIs, some of the profit numbers, and so forth. So on the right, you can see kind of the distribution of the numbers from earlier this year, and the average utilization was 71.5 for these independents. So the point is, you want to look at some of the KPIs on the left. Average revenue per project. Again, the organizations that succeeded the best really sell long, complicated projects to where they're going to have a lot of people on the project and work for a long time, so no one's sitting on the bench. They're longer in duration, and then again, companies like this, again, we'll get back to that revenue leakage. They have less revenue leaked than others. Again, that helps with profitability because those are points, you don't get that 3.5% back or 4.5% back. It's lost revenue, and if you're making 5% profitability, you could have made 8.5%. So again, something very important for you to understand. And so again, you look at companies with high levels of billable utilization, and you can see they make a lot more profit than those that do not. So again, focusing on that from an organizational standpoint is critical. The next is minimizing project overrun. Again, like I said, about 20% of the projects delivered are late and they're over budget. So what can an organization like yours do to limit that? Well, what was interesting, again, the first row was the time for a new hire to become productive. That's your ramp time, and that's important because it's not just an individual who you just hired sitting around reading. Chances are they're being mentored. They're doing a number of other things that will take other people away from the delivery of the service. And so, we think if you get people up to speed quicker, they're out billing quicker, and that will help you improve profitability. And again, that service discount that we hate, it's not hugely different between those. But again, when you start looking at percentages, the difference of these, there is something critical there. And again, EBITDA obviously is important, but right above that, I put employee attrition because, again, we're trying to reduce that number to less than 10, if not less than 5 going forward. So again, when your projects work well and people are delivering and they're getting started on time and done on time, it creates a happier workforce, more motivated, which ultimately, reduces attrition and will help you raise profitability. The third KPI is project margin. So this is really when you're delivering the services, how profitable are you? I mean, obviously you want to sell a service with a high project margin built in, and you can see last year it was around 33%, which is more than fine. But we try to get organizations to make sure their project margins are over 40%. And so what that means is really taking the time to understand what the client needs and what people you can bring on the project to help you achieve your desired project margin. It's the right mix of junior and senior employees to get the job done with high levels of quality, on time, on budget, at a sufficient project. And so, some of the things we saw really have to do with it is the deal pipeline. Again, the deal pipeline, if you're not selling enough, you're going to have to discount more. If you discount more, that automatically cuts into your project margins. So again, keeping your sales force motivated and getting them out there selling and trying to win bids is critical. Annual revenue per billable consultant. There's a big difference there, $209,000 compared to $176,000. And that's important because there's a better chance the organization is operating more efficiently, so people are moving from project to project to project seamlessly, not sitting on the bench for a week or two and then going back and starting again. Again, keeping everybody busy, everybody billing will ultimately help project margin, which will ultimately help your profitability. And then the fourth KPI is maximizing annual revenue per billable consultant. And it's an interesting key performance indicator compared to annual revenue per employee. You know, obviously, we want that number as big as possible, and we think that every one of your billable employees hopefully can deliver over $200,000 in annual revenue. That tells you how well you deliver services. And so what we did is we looked at all the numbers, and we could see that obviously if they're selling more services and delivering more, you're going to see a higher change in PS revenue. And it's quite significant in this particular example, you know, because it's over double. So in other words, you know, try to get your consultants to bill over $200K a year. You'll be much happier. But you can also see they're selling bigger projects. Like I alluded to earlier, selling long-term projects with a lot of people on it really stabilizes your financial infrastructure, because the people are going to be billing the same client every 2 weeks or every week, and the cash flow will roll in, and therefore you're financially a lot more healthy. You know, building the backlog, building the pipeline, keeping billable utilization as high as you possibly can. Again, all of these areas can ultimately help you achieve your desired levels of profitability. And then the other one, I just talked about revenue per consultant, but this is revenue per employee. And of course, this takes all your consultant and all your overhead in one big bucket. And so we look at about $180,000 per employee as a good number to shoot for. And you can see that we can see annual revenue per billable consultant is a lot higher in this particular case. But again, it means your organization is running more efficiently. You have less need for overhead. You're growing a lot faster. You're writing off a lot less work, because that's, you know, revenue leakage, you know, that's a big problem for a lot of companies. But what was also interesting is these organizations do a lot better job of selling and winning bids. And so again, you take all of these things together, they ultimately drive profitability upward. And we always like to say that every area within your firm really is connected, and that's why this integration between your information infrastructure makes perfect sense, so that the people in HR understand the type of people they need to recruit and hire, because they'll yield the highest profitability. Service delivery understands the services being sold, so that they can, you know, make sure they've got the right methodologies and tools in place to quickly deliver the services and so forth. So again, every aspect of your company really is combined. And so I think it's my second to last slide here. We looked at integration with the core ERP or the core financial management solution, so like an Intact. And, you know, again, we have about 55% in level 1 and 2, 25% in level 3, and then those top 2 levels, you know, 20%. You can see that as these organizations show greater levels of integration with the core financial management solution, they achieve higher levels of growth, profitability, you know, employee satisfaction, and of course profitability, which is what, you know, again, most people here are looking to achieve. So again, making sure that you're sharing that information across organizations where appropriate, you know, will help the organization really run as one, as opposed to different silos. And so on my last slide, again, I talk quick, and it was always fun, you know, seeing some of these slides and discussing them. You know, we think that improving financial performance, you know, first of all, like I said, aligning the organization, the ability for everyone to work together, and then figure out what services are the best, what clients are your best, maybe what geographic regions are your best to work within, so that you can create sales and marketing programs to go after the best possible areas. Again, building the pipeline, building the backlog, that ultimately reduces the ability to discount services, and then again, selling big services, which is not easy to do, but if you run well enough, it'll be a lot easier to do. And so managing all the costs all the time, that's really where you're going to get ahead in the marketplace and move not only maturity up, but really what you're going to do is you're going to move you know, financial success up. So again, all critical information. for you to understand. And I appreciate everyone listening to me. And now I will pass it to VJ.
Great. Thank you, Dave. You know what, it was really interesting, the points that you made about integration. And because, in order to be able to look at all of these KPIs, you need to have really, data collected across this entire life cycle. And I'm just going back to your last slide for a second. And so the point of integration is really important because, like you said earlier, financial maturity, even though it has the word finance in there, it's actually something that spans the complete life cycle. And so one of the things that we've done at Intact, for our project-centric, customers and companies is to provide really rich interfaces into, all the types of applications that services-based companies are using today. And that starts with CRM, and, a lot of folks are using Salesforce. Many folks are using, other off-the-shelf CRM applications. So, one of the focal points for us has been as a, provider of ERP software is make sure that we have really rich interfaces into CRM systems, because that's where the whole process starts, right from the bid. And then the other thing is it's not just moving the data, from the CRM system into, the financial system, but also to provide visibility into historical financial information, because that can be really powerful, as your sales team is, making those bids to get a sense of, what costs were, in the past, right, in terms of historical project costs. That can inform, much more intelligent and profit-maximizing bidding. So the linkage, I want to stress that the linkage between, the ERP system and then the other systems like CRM or PSA systems, right? So we have customers that are using, dedicated PSA systems. We have customers that are using our native project and resource management capabilities as well. But that's absolutely essential because, the, hours are often being tracked in those systems, the hours that drive cost, the hours that drive billing. Time is, captured in those systems as well, and outside systems. So having a really easy way for data to flow back and forth is really important. At this point, what I want to do is get to some of the questions that have come up. So, Dave, one of the questions was around utilization, right? Because we said that you had the notion that that was, a very, very key measure to look at. The question that came from the audience is around what gets counted towards that utilization calculation. A lot of times when there's onboarding, there's training or shadow hours. Do people typically include or exclude those when calculating utilization?
Yeah, well, those hours, the training, onboarding, mentoring, those are not counted. The hours that are counted are just the hours the individual is physically billing. So let's say I'm a seasoned consultant and I'm doing billable work, but I have somebody, shadowing me. Well, if I'm really delivering work and delivering value to my client, then that is part of the utilization process. So, again, there are always things that will cut in the way of utilization. And as a matter of fact, I threw out the number 70% or 75%, meaning, 1,500 hours a year or so. Well, if you start tearing that data apart, what you'll see is that junior level employees, the ones that have started and they know what to do, they may be billing out 1,900 or 2,000 hours a year, whereas some of your more senior consultants who may be doing, part project management or part non-billable project management, let's say, their utilization might be 20%. And so at the aggregate, all the people, all the hours and so forth, you shoot as a company for a 70%, realizing that you'll have people by design that are going to be, less than 50, but you'll have people by design that are 70 or 80%. And again, the goal is, training doesn't count with billable utilization, but you need to train your employees. Vacation, hurts your billable utilization. But you know what? People have to take vacation. So again, there's always things that will go against you, making it impossible, basically, to be 100%. But you try to be real efficient when you are billing. You're not doing non-billable work when you're at a client site, and you're making sure you capture all the hours that you spent with each client or each project to make sure that they're invoiced, and ultimately helps you with the utilization.
Great. Another question that I'll take a first pass at, Dave, and then if you have any other insights, feel free to add those. The question that came in, it was really around, and I'll paraphrase this, is how do you collect all the data that is going to be driving the calculation of these KPIs? And so that's a great question because we talk to a lot of companies that come to Intact, and they don't have visibility into these KPIs because the process of tracking and calculating that data is so manual and so labor intensive that many times people don't go through that exercise on a consistent basis. And so one of the ways that you can improve the data collection process is really by automating that service delivery lifecycle. So one of the benefits of moving to a systems-based approach, for resource management, for resource scheduling, for project and task management, for time and expense capture, is the fact that, the more you can automate that, it obviously makes those day-to-day processes a lot more efficient, but then you're beginning to collect all of that data in one place. And so the data collection is just a natural outcome and a natural, outcome of the process automation. And once you have the process automation in place, the data is all in one place, and it's data, again, that cuts across the entire life cycle from sales to service to finance, so that it's a consistent set of data that everyone can agree on. And once the data is all there in one place, one of the huge value that people get out of the Intact system is having all of these metrics at their fingertips in terms of dashboards and trends. And we actually have additional webinars that focus on reporting and analytics for services companies, where we show you how you can do this and actually the kinds of visibility that you can get. So process automation is important because it begins to collect that data for you, and then having an ERP system with really rich capabilities for providing visibility into that is important as well. And I'll make one more comment on that around collecting data. It's really important, as you think about process automation, to consider how well adopted these systems are going to be. Whether you're talking about project management or tracking, time and expense, tracking costs, tracking hours. You don't want to have a system that's too complicated for that, because that's going to slow down the collection of data, because people just aren't going to adopt the system. They may not enter data into that system on a regular basis or a consistent basis. So think about how well these systems fit your processes. So just wanted to provide a few comments on that question that came in. Dave, do you have anything to add, or should we get to another question here?
Well, just a couple things. I mean, again, I think that this cloud-based computing has really helped move the information out to the field, that enables people to, input the information one time and do it electronically versus manually, where, information can get lost, and therefore, that's the revenue leakage problem I was talking about. But also then they have real-time information in terms of project status, project cost, and so forth, so that they can adjust on a daily basis what they plan on doing the next day to make sure they have that. I mean, the advent of these dashboards that have been created, and they used to just be created for executives. Now we're seeing a lot of the dashboarding capabilities pushed down to individual employees with their specific needs. You know, they understand from these dashboards what projects they're working on, how they're performing on those projects, what might be an area that could cause them concern going forward. It might be that they're double booked and they don't want to work 16 hours a day and things like that. So the ability to put this information and integrate this information over the cloud has really helped this market over the past 5 or so years become a lot more efficient at getting work done. So it's a huge area of emphasis here.
Great. No, those great points, Dave. So Dave, one of the questions is about overhead costs. How important is it to monitor and track those, and what are you seeing in terms of maturity, people tracking that measure? Any comments on that?
Yeah, well, we about, gosh, I'd say 7 or 8 years ago, we started incorporating an income statement in our research. So direct labor, indirect labor, billable time, sales, marketing, and so forth. And of course, overhead tends to be that catch-all, for facilities and for other things. And it's interesting in professional services, we tend to have it a lot lower overhead than our manufacturing counterparts. I don't have the numbers staring in front of me, but I would say, it's around 10%. And so, obviously everyone, very few firms with, more than 10 people have a 100% consulting staff. So as your organization grows, you need overhead to better manage a lot of the things that are happening while your consultants are out billing. So overhead isn't terrible, it really is necessary, but the point is that you should monitor that, because that's going to tell you when it gets too high, what can you do differently to improve financial performance. Again, your sales reps are doing their job, and you know what you're going to pay them when they sell something. I mean, a lot of the other organizations have specific numbers that they can more easily, track, follow, manage, and so forth. But overhead tends to get lumped into this one big bucket, and then all of a sudden, at the end of the quarter or the end of the year, you look down and go, oh my God, our overhead was 20%, and you realize that's why you didn't make any money this year. So again, understanding these things, managing them in real time, as an executive especially, will help you, make more profit and ultimately help you grow faster.
Yep, great point. And the one point I'll add to that, Dave, is that for many of the companies that come to us, so growing services organizations that come to us, one of the areas where they're looking to reduce non-billable overhead is in accounting, actually. And so, they're faced with the situation where the data is so disconnected that people are being hired to just collect data in spreadsheets to drive things like billing or to drive things like revenue recognition. And, people are looking to technology to, reduce really the need to, keep adding what ends up being non-billable headcount as the business grows. So just wanted to add that additional comment there. As we wrap up today's webinar, wanted to do a couple things, leave you with pointers to some additional resources. Again, you'll be getting a copy of these slides in email, so you'll have those for your reference. If you're interested in learning more about Intact, we do have webinars that drill down into the topic of reporting and analytics for project-based companies. We invite you to attend one of those webinars where we'll get to the next level of detail around how you can do some of the actual collection and sharing of the KPIs that Dave's referred to. And of course, we have general information on Intact as well. And so with that, I wanted to thank Dave Offerberth for being with us today and sharing his insights and what SPI has done. And also, on behalf of Intact as well, wanted to thank everyone for taking time out of their days to be with us and learn a little bit more about these KPIs. So thank you, Dave, and thank you to all of our attendees as well.
You're welcome.